Today on the CEO Barbecue, we're looking for gold production in Nicaragua, Arizona, Nevada, and Guyana, together with Mako Mining. For a bullet point summary of this and all other CEO interviews, please go to resourcetalks.com and subscribe to our free weekly newsletter. The company you're about to hear from has not paid us for the production of this interview, but this interview is still intended only for experienced speculators because this is venture capital and mining is a very risky industry where failure is the norm. All conversations are general and impersonal in nature, and they contain forward-looking statements. I'm not a licensed financial advisor, and my business sells content-producing services, which also makes me biased. So before continuing on, please talk to an independent investment advisor with a good long-term track record, because your capital is at risk, and also visit setterplus.ca where you'll find the company's official filings. If you're not 100% sure you understand all the biases and the disclaimers that I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said herein. That all said, Mako is a small gold producer who sold close to 8,000 equivalent gold ounces last quarter, which was mostly gold, actually. The operational foundation for the company is the San Albino mine in northern Nicaragua, which has been the company's key cash generator since production began here in 2021. This is a very high-grade operation, but Mako believes both the open pit and the accompanying mill have more to offer. So they think there's more exploration potential, and maybe there's more expansion potential for the mill as well. So that's something I'll be asking about later on. It's not the only asset the company has, though, because in 2024, Mako moved to merge with Gold Source Mines, adding the Eagle Mountain Development Project in Guyana as a potential next growth leg. And again, we'll talk about that as well. And then in March of this year, they completed the acquisition of the Moss Mine in Arizona, giving it the potential for a second producing base in the US. And then most recently, at the end of last month, Mako entered into a definitive purchase agreement to acquire the Mount Hamilton Gold Silver Project in Nevada from Sailfish Royalty, which, by the way, Mako's CEO is on the board as an executive chairman of Sailfish Royalty. So as you can imagine, that will be part of the conversation, and I will have some questions around that as well. Mako is listed as MKO on the TSXV, where the average 3-month volume is about 112,000 shares. The stock's 52-week high is $8.76, and its 52-week low is $2.72. With a market cap of just under 670 million Canadian dollars and just over 87 million shares outstanding, today this is a $7.70 stock with a 50 and a 200-day moving average at respectively 7.69 and 5.72, which means the stock is now trading above both of them. Moving on to the share structure, an important thing to note here is that over 50% of the shares are owned by Wexford Capital, and how and why those shares were acquired will be discussed later on as well. Again, just over 87 million shares outstanding. There's no warrants, and there's just under 2 million stock options, as well as just over 1 million RSUs and DSUs combined, bringing the number of fully diluted shares to just under 90 million. That means an increase of just about 3.3% in shares outstanding could happen if all the dilutive securities get exercised, which would then result in about a 3.2% ownership dilution if, and that's always a big if, but if all dilutive securities actually get exercised. Talking about capital, I'm now going to be going through their latest financial statement, which shows me the numbers as of September 30, 2025, which is almost 3 months ago now, and thus covers up until the end of Q3 of 2025. Now, at the time, the company had in total just over $56 million in current assets, 27.7 million of which in cash and cash equivalents, and the other large chunk, 22.5 million, was in inventories. In terms of liabilities, I'm seeing 20 million in current and 33.5 in non-current liabilities, with the largest chunks, respectively, or in current, being the $19.5 million account payables and accrued liabilities. And then in non-current, the largest chunks are just provisions, really. So provisions for reclamation. And there's also a deferred income tax in there as well, with a term loan standing at about $5 million on the books. And that loan carries a 10% interest rate per annum, compounds semi-annually, and it recently was extended to mature on March 31st, 2029. Notably, that loan is payable to Wexford, again, the company's largest shareholder, so that will be part of the questions as well. Also worth pointing out, this financial situation or snapshot is again for September 30, but Mako raised $55 million at $8 per share at the end of October this year, which wouldn't be reflected in these financials yet. And I suspect their cash position is over $60 million right now. Moving on to the P&L for the 3 months that ended on September 30. Again, unlike most companies I speak to, Mako actually has revenues. They were recorded at about $27.6 million to be specific for the 3-month period. That's an almost double the amount recorded for the same period last year. And that revenue came from the sale of 7,830 gold ounces produced at an average of about $2,500 gold, leaving about $9.5 million of gross profits, which is more than twice the $4.5 million of gross profit for the same period last year. The operating cash flow sat at about $4.3 million, which is a 52% increase year on year after selling gold at an average realized gold price of $3,454 versus $2,409 last year for that same period. I'm looking at operating cash flow here again. So this means that Mako made about a $550 or $551 an ounce in operating cash to be specific, whereas last year that number was just about $435 an ounce. Looking at the cash flow statement, though, given the secured debt investment and the expenditures that were made for P&E and so on, the change in cash for the quarter was actually a drop of close to $900,000. Talking about expenses, normally for an exploration company, I like making the exploration to administration ratio, which would show me how much money goes into the ground versus how much goes towards what I call bankers, lawyers, and management. But here, I think it makes more sense to look at how much of the revenue is spent on G&A. And for Mako, that number is just about 10%, 10.4% to be specific. Now, is that going to stay the same, or could they grow the bottom line without growing the corporate office? And how stable is the financial situation under the current assumption, this gold price and the jurisdiction and everything else? Those are all questions that hopefully I can ask later on in the conversation. But in the meantime, I would also briefly like to remind you that mining businesses can change relatively quickly. So these numbers may not be entirely representative of the current situation for Mako, and I might be seeing things wrong as well. So it is your responsibility to try to get up to date by going to setterplus.ca. Now, I mentioned a couple of times that I have some questions for later on in the conversation, but for this to actually become a conversation, I'm going to have to shut up already. And Akiba, I'll give you the word here. But first of all, thank you so much for sitting down with me today.
All right. Thanks, Antonio. Appreciate it.
The pleasure is mine. And I don't plan on wasting too much of your time today, maybe a little bit, though. But this is the CEO Barbecue, so I'm going to have to ask, how do you like your steak?
The steak is growing, right? So I think we probably had like a little small cut maybe a couple of years ago, but really starting as you kind of laid out in February of last year, we embarked on our acquisition strategy. So Mako is a completely different company today than it was 18 months ago. We now have 4 assets, 2 producing mines. The second of which is in Arizona, which will be in steady state, let's call it commercial production in the latter half of Q1 of next year. So it's in production, but not commercial at this point. And then we, as you pointed out, we also announced a definitive agreement, but for all intents and purposes, we now control the Mount Hamilton asset in Nevada, fully permitted as of about a week ago. Our guys were over at site last Wednesday and Thursday to do a lot of the kickoffs for the pre-construction activities, and we do intend to start constructing Mount Hamilton in and around April of next year for first gold production in the first half of 27. And then we're in the advanced stages of getting our Guyanese asset, Eagle Mountain, permitted with the idea that we're going to be constructing that towards the middle of 2027 for first production on that in the first half of 2028, all funded with cash on our balance sheet, inclusive of that Canadian $50 million raise or US $37 million raise net of fees, costs, commissions, plus the cash flows that are coming from our 2 and soon to be 3 assets within our portfolio right now. Mm-hmm. So we're in great shape. Mako is now what I would consider to be a significant company, where before I would view it really as a mom and pop organization where we actually did like to use our team to go and build these high grade, highly profitable mines. But now we're definitely more substantial company where I do think we have a lot more relevancy for the public investing community today versus what it was even just a few months ago.
That still doesn't tell me how you like your steak, though.
So in terms of like how I like to cook it, I like my steak to eat medium rare. I would consider Mako having gone from the rare to the medium temperature at this point.
That's actually that's a safe option. I'll take it. So you like it a little bit red, but you don't want to take too much risk with
Sure.
blood there. Jokes aside, though, Akiba, and since this is your first time on the actual barbecue yourself, we'll have to go through what I call the smell test first, which intends to understand more about what the incentives in the track record of management are. Starting off with yourself and your track record, who are you, and have you made more money for shareholders than what you've spent during your career so far?
Sure. So my career is twofold. One is on the investment side, and then one is on managing companies before, which I'm doing right now exclusively. So I started my career after business school, and initially for a small South African project finance bank for the mining community back in 2006, and I left that group to go start a new hedge fund. I was employee number 3 within this larger hedge fund group called Red Kite, and then we helped get the mine finance funds off the ground, which eventually became the Orion funds, the largest mining private equity funds in the space these days. I left Red Kite at the time before they changed the name to Orion, split the company in 2011 to go and take over the mining portfolio of another hedge fund and private equity group called Wexford Capital. So as you pointed out earlier in this, is that Wexford does have nearly a 50% shareholding in Mako. They own about 47% right now. And I did 2 things for them. One was to manage a pretty well diversified portfolio of public companies and to a certain extent some private ones as well. And then starting in 2012, we put together the initial bones of what eventually became Mako. So the track record is really twofold. One was really just on the public portfolio side of things, which we really won't get into. And then secondarily, it was the creation of the predecessors of Mako. One was a company called Marlin Gold, which was developing an asset in Mexico, and then frankly was not a financial success. So this was a deposit in Mexico that ran through a lot of challenges associated with it. And in 2014, to really transition and really lay the groundworks of what eventually became Mako, we decided to start the pivoting from where Marlin was to eventually where the company is today. We did that initially by starting an affiliated royalty company called Sailfish Royalty Corp, which you did highlight earlier as well. Sailfish was established as a subsidiary to Marlin initially in 2014. It put on a large encumbering stream on the Nicaraguan assets that we're currently mining right now over in Mako. And over a period of about 4 years, it was really my intent to use that stream as a mechanism to really merge the 2 companies together between Marlin and the predecessor, a company called Golden Rain Resources. It did not happen. We had a board on the other side that didn't see eye to eye with us. Management teams of a variety, if you will, that also didn't see eye to eye. So after a period of about 4 years, we finally negotiated an agreement with them to merge the 2 companies together. That also required a restructuring of the stream to make it a lot less encumbering than it was back in 2014, such that it's effectively a 2% net smelter return royalty right now. Initially, I gave up my job as interim CEO of Marlin. I took over as interim management in 2015 when we were having some operating difficulties over the mine, and I really wanted to take more control of the situation at that point in time. And then after that happened at the end of 2018, the management and the board still didn't see eye to eye, and eventually we flexed our muscles a little bit where I took over as management in the summer of 2019. Populated the board with our guys, if you will. Brought in the management team, Jesse Munoz, and the wholly owned EPCM firm that his family used to operate to really take control over at management. And that really was what I view as the beginning of where Mako is today. So we did raise capital, which allowed Wexford to take majority control of the company at that point in time. To get San Albino up and running, we raised a total of US $40 million in two $20 million financings, one in the summer of 2019, and then another 20 million in the summer of 2020. There was an additional US $15.15 million of debt capital that was also issued by Wexford to get the company to first gold pour at the beginning of 2021. And then we took a third-party debt piece of about $6.4 million to a third party in February of 2021, which was the last time the company raised any net capital of any sort until we announced the equity deal of a couple of months ago after we announced the acquisition of the Mount Hamilton project. So since San Albino turned on the back of that US $40 million of equity capital and then the $21.5 million US of debt, we were able to finance exploration, both expensed and capitalized, so a little bit different than the numbers that you were quoting before, in excess of US $40 million over the course of the last 5 years. We were able to mine the mine profitably. We were able to repay the entirety of the 21 and change million dollars of debt that sit on the balance sheet, such that we actually don't have any debt on the balance sheet right now. We grew our cash balance from zero. We were running on fumes at certain points in 2021 to the roughly US $70 million that's on the balance sheet today. And that's after a US $37 million net equity capital raise that we did last month. And then we use that really as a platform to go and build out the company, making these 3 acquisitions. Now, the other aspect of track record are really the two, what I view as the differentiating aspects of Mako. The first is the controlling shareholder. Wexford has been an extremely successful investor over the course of the last 30 years or so. For your audience, probably the most high profile and successful investment that they made was the establishment of Diamondback Energy. Right, so FANG on the NASDAQ, it's a member of the S&P 500. Diamondback was effectively started in a very similar fashion to Marlin and Mako. Initially privately, back in 2006. There was initially operating issues associated with it, very similar to Marlin. And then there was in the private sphere a pivot where new management did come in. We populated with best-in-class management, went public with that in 2012, and then made a series of highly accretive acquisitions in and around the Permian and Delaware Basin to really grow that company into the company that it is today, producing nearly 1 million barrels of oil equivalents per day, one of the largest independent oil producers globally. And all of that really does have a very similar template to the business that we're building out of Mako. Actually, even Diamondback has an affiliated royalty company called Viper Energy Partners. It's a royalty company that's a multi-billion-dollar market cap that effectively functions as an affiliated royalty vehicle to the producer. So there's a lot of Wexford DNA that is in a lot of the portfolio investments that we invest in and how we manage the business. The other aspect of this is that Mako is unique, is that from inception, it was set up to acquire and operate multiple mines at the same time. We wouldn't be able to do what we do without actually having our own internal EPCM firm that's capable of running that for us. So my COO, Jesse Munoz, I've worked with him really going back since pre-Wexford days. Back when I was over at Red Kite was the first time that I met Jesse. I guess it's now about 16 years ago. I met him when he was doing the original procurement and construction management work for the original Silvercrest mines. So Silvercrest if you know the story over there, started with an open pit heap leach in Sonora, Mexico, called Santa Elena. Jesse actually was the one that built Silvercrest back for, at the time, the CEO of the company was Eric Thier, who's our non-executive chairman over at Mako. Jesse and Eric met each other for the first time. Then I met Jesse very soon after that meeting. And Silvercrest was always kind of a template for how we were going to be running our business from a successful perspective. They transitioned from a relatively high-grade open pit heap leach mine to an underground over at Santa Elena. They were acquired by First Majestic, and then there was a spin-off company called Silvercrest Metals that was also acquired for in excess of $1 billion recently to Core Mining. So Eric's had a tremendous amount of success on exiting a variety of assets and companies that he's been involved with. So we do like to kind of use everybody's experience and track record to try to establish best practices for how we build these companies and eventually how we exit these investments.
Mm-hmm. I know you, as you mentioned, you hold the position of executive chair at Sailfish Royalty. But outside of that, do you currently do anything else? Do you hold any other executive or board positions with other companies?
No other board positions. I still technically consult for Wexford on an unpaid basis. So I usually just use that as an opportunity to get yelled at by Wexford every now and then. So it's important to keep channels. And then also, anytime that they have a particular investment that they're looking at, not affiliated with Mako or Sailfish, Chuck from Wexford usually runs it by me as well.
How do you split your time between all that, Sailfish and a little bit of Wexford here, Wexford there, and yeah, how do you split your time between all that? How much of your time goes toward Mako?
Yeah, I view everything as one and the same. Right? So I do multitask. I would say because operating companies are inherently more time involved, I do wind up spending the vast majority of my time associated with Mako. This is kind of an important characteristic because we actually do get a lot of commentary and have gotten a lot of commentary in really now the 13 years since we've been involved, at least from the public side of things on the mining side. It's like, well, how do you manage all of this? We think of everything the same. It's like we don't really view investments that we're making in the mining space as different than investments that we're making in the public market side of things. Maybe with a couple of caveats to that. Obviously, if we're going to be buying an asset, we do need to own it for a long period of time. At least that's how we're going to underwrite it. Whereas on equities, you do have a little bit more flexibility on how you exit small and minority-sized positions, but we just don't think about the world like differently. Is that we don't pay too much attention to what's on the screen in terms of, unless you're talking about the actual valuations of things. And if something actually looks really attractive to us from an asset perspective and looks attractive to us from a risk perspective, and we feel comfortable enough on executing on it, how we manage that thought process over at Mako is the same as how we manage it over at Sailfish. It's the same as how we manage it through Wexford. It's like it really is the DNA and how these companies are managed, and you can see how that impacts us. It makes us, I think, a little bit different than some of the mining companies and the royalty companies that you may be involved with. But everything that we look at is, all right, how do we generate good investments? And the way that we define good investments is how, like every investor really should, is right, how much money you put in and how much money you're taking out, and how long is it going to take you to do that relative to the risk that you're taking.
I might go a little bit more in depth on this further on in the conversation, but while we're on this topic, there's one thing is managing the time between the different companies, and the other thing is how do you manage a conflict of interest here in a situation such as the current one, where again, you're essentially buying an asset off of Sailfish. So how do you manage that conflict of interest?
So two things. One, the last two acquisitions that we did with Moss and with Mount Hamilton It happened to have been that Wexford was instrumental on how it was financed, how it was structured, but Wexford had nothing to do with the actual like ownership of either asset. So we'll go over a little bit with the Moss one, and then a little bit about all the connectivity on the Mount Hamilton, and then I'll go back to your specific question about like conflicts of interest in general. So Moss was an asset that was in bankruptcy by this Canadian basket case of a company called Elevation Gold. They declared bankruptcy in July of last year, 2024, and it became clear that we had a pretty advantaged situation in that bankruptcy. We were very familiar with the asset. I view our operating headquarters to be in Tucson, Arizona, in the southeast side of the state. Elevation happens to be, or the Moss Mine happens to be in the northwest part of the state. We've made multiple site visits to it over the course of the last 10 years. We were intimately aware of their financial situation, and we actually told a bunch of their advisors that there was really nothing to do, but if you ever go through a restructuring, we're definitely going to be particularly interested in it. So I did feel very optimistic that we were going to be the winning bidder in that bankruptcy process towards the tail end of 2024. If you went over Mako's financials at the time, especially at the end of Q3, because I think this year is actually the third year in a row we've had a particularly weak Q3 and then a particularly strong Q4. 2024 was not different. So if you look at our financials at the end of Q3 of 2024, so last year, we had like all of about $5 or $6 million on the balance sheet at the time. Even though I was planning on having a pretty strong Q4, and I kind of understood that the clearing price of this bankruptcy would be in the mid-single-digit $1 million range, I was not comfortable about having Mako underwrite an acquisition like that, given where our financial resources were at the time. So we actually had Wexford, an entity that they created de novo, acquire the Moss Mine, and we closed that on December 31st of New Year's Eve of last year. And then there was an agreement that once that happened is that for Wexford's costs, so including legal costs, which were just about $150,000 or so, minus any like gains that they would get through. I mean, even though this was mining stopped in the fall of 2024, it was still producing gold through this residual leach. So all of the benefits from that gold cash flows would transfer over to Mako. So net of all costs, net of all equity contributions, but also for the benefit of Mako, the cash flows that it got through the residual leach in that 3-month period of time that it took to acquire the assets. Wexford would have agreed, subject to the regulatory approval, to sell the asset back at their cost, which wound up happening. And because of all the cash flows that Moss generated in that intervening 3-month period of time, the net acquisition to Mako is only about $2 million to acquire the asset. So here was one where we used Wexford really to do a couple of things. One was to obviously rent balance sheet a little bit, right? So they had the financial resources to do it, where Mako didn't really, even though by end of Q4 of 2024, we did have the ability to execute on that. And then secondarily, which actually became, I think it was something that definitely crossed my mind, but it actually was the more important of the two, is that Moss was a mess. Like it absolutely was not an operation in tippy-top shape when we acquired it. Going through Wexford in that particular structure was essential in doing this, because we didn't have to wait for any regulatory approval on this. Is that the bankruptcy judge approved the bankruptcy at 11 o'clock in the morning on New Year's Eve, and we took it over at 11:11. 11 minutes later, we got the keys, and we spent the next 3 months just kind of like fixing all the issues that really were, frankly, like unsafe and to a certain extent, operating that asset in that intervening 3-month period of time. So Wexford was essential from a tactical perspective, but I wouldn't exactly call that a conflict of interest. It was only a positive side of things on that basis. The Mount Hamilton one is similar and a little bit different, where Here was a situation where I was pretty the asset was owned by a third party private equity group named Waterton out in Canada. I actually originally tried to acquire Mount Hamilton back in 2014 when we were kind of going through that operating pivot, if you will, over at Marlin. For it's another long story that we can go over in a longer interview as to why we were rebuffed in 2014. But this third-party private equity fund managed to be the winning bidder of Mount Hamilton in 2015 for an acquisition of US 30 million plus the assumption of about US $10 million of effective liabilities that came with it. So about $40 million plus holding costs was their acquisition cost. Now, I knew Waterton didn't want to advance this. They tried to vend it off to another private company back in 2024. So we were in discussions with that company for well over a year in one form or another to try to acquire it through them. And then when that company lost the option agreement in the middle of this calendar year, I then approached Waterton with a cash deal. Now, in this particular circumstance, Mako didn't have the clearing price on this was US $40 million. One, Mako didn't have US $40 million on the balance sheet, so it would have required a capital raise to do it. Likewise, Mako didn't really have like a great stock price, right? So it had assets that were doing really well, San Albino, and then through this pretty sharp acquisition over at Moss that we completed in March of last year. And myself, the board, and especially Wexford had no interest in raising equity at the level that Mako was trading at. So anytime that somebody says something like that to me, you can't do this because your stock's too cheap, I do have the ability to kind of think of creative alternatives. So one of those creative alternatives is like, wait, we actually have an affiliated royalty company over here. The affiliated royalty company actually has an asset within it that I know I could sell at a really high price and an attractive valuation. So why doesn't Sailfish take a bridge loan from Wexford, the amount of US $40 million, use that $40 million to acquire it from Waterton, complete that transaction, repay that bridge loan through the sale of that asset, which is a royalty on something that Mako is not involved with, the Spring Valley project that also coincidentally happens to be owned by Waterton, and then vends the Mount Hamilton asset to Mako, the operating team. It's effectively the same family, but the Mako is the operating part of this business. Vend it in return for a 5-year gold stream. So 4,100 ounces per year at 20% of the spot price of gold, subject to an effective cap at $3,700 an ounce, such that at today's gold price, it would be less than 4,100 ounces a year. And then once that 5-year gold stream is complete, then Sailfish would be entitled to a 2% net smelter return royalty. So if you actually think about how this was structured, is that Mako wound up buying this really attractive two-stage project, which is a 60,000 ounce a year, roughly, producer, fully permitted in Nevada, 600,000 ounce updated resource, although we think with pretty clear exploration success, we can get this to about 1 to 1.2 million ounces in this oxide heap leach asset. And then underneath this, which we can go over a little bit in more detail later in this conversation, there also happens to be this very large scale and relatively high grade critical metals tungsten deposit situated spatially about 150 meters below the gold asset. And you did this without issuing any equity capital at the time, right? So here, Mako was able to acquire this asset without actually having to issue any relatively cheap equity. And we did that because we actually had all of the connections within the family working together. You had Wexford, who was there, that was supporting this from a bridge loan. You had Sailfish, which was there, which had a variety of assets that were leverageable and the ability to sell them to eventually repay that bridge loan and then some. And then you had the Mako side, which has the operating structure with, at the time, 3 other assets, two effectively producing mines, albeit Moss was not in commercial production at that point in time. And then the Guyanese development asset over at Eagle Mountain, all acquired in a very, very sharp way over the course of the last 18 months, and then acquiring this fully permitted project in Nevada without having to issue any equity capital. I don't think there's another mining company that would be able to pull off something that we pulled off here. Now, to your point about conflicts of interest, there's actually a lot of conflicts when you think about it, right? So I do think when we get in these discussions about conflicts, is that no conflict is not the same decision process as good and bad, right? Sometimes a conflict can lead to a bad decision because people are looking after their own pecuniary interests as opposed to shareholders, but they're not necessarily the same thing. Right. So it goes back to our DNA. Like the only thing that we care about are good, sharp investments. We're not embarrassed to be using tools that are available to us because of these conflicts. And we do this in companies like Mako. We do this with companies that are $50 billion market cap companies like Diamondback, who they also have a lot of conflicts with their affiliated royalty company called Viper. But they manage through that because the DNA of these organizations are to do good deals. Now, how they're actually managed within the company from a governance perspective, yeah, we do have special committees. Like I definitely give kind of guidelines on both companies that this is what I think Mako can accept. This is what I think Sailfish can accept within these parameters. You guys deal with the specifics within those parameters, and I do give enough space to both special committees to go and negotiate on that basis. That being said, if you're an investor, for whatever reason, you don't actually trust us, believe us that that's going to be the case, you can't invest in these companies. Like if I wanted to do things that would be bad for my own personal interest against the benefits of shareholders, there's no governance structure that we can put in that would prevent that from happening, right? So there is an element over here where I actually respect investors saying, look, we need to be in situations where there's clear-cut, bright lines in terms of how we manage this, because I can't go over the details for every micro cap, small cap. I guess we've now graduated from the micro cap space to the small cap space for every company in my portfolio looking at this. So I can't invest in like that. I get it. Mm-hmm. The other side to that is it goes back to this to the tools in our toolkit, is that we have more of them than other companies. And that's access to capital, access to engineering experience, access to kind of understanding how to navigate through bankruptcy, how to navigate through acquisitions and deals like this. And we use it to our advantage. And never been embarrassed to do that.
Yeah. I like the in-depth answer there. And then it's something that might keep coming back here as we start talking a little bit more specifics. I do want to move on and talk about skin in the game. Management and insiders are noted at about 4% of the company. In general, when I look at, again, exploration companies, that isn't all that much. In absolute terms, you're an almost $700 million company. 4% is not nothing. But are there any plans to increase shareholder alignment here?
Yeah, so I personally own outright a little over 1.4 million shares, and then with RSUs that are close to being vested, that takes me up to about 2 million shares in aggregate. So as you said, on a fully diluted basis, this is a roughly 90 million share count company. So you're dealing with something that's just over 2%, like 2.25% for me personally. I could tell you flat out that that's actually enough from me being in a position where it is going to make a difference from my personal financial situation, that if Mako is a success, that actually will flow down to me in a way that I'm incented to do that. Now, I've of that 1.4 million shares outright, at one point between the Marlin shares and then once we took over management in 2019, and then subsequently I actually went out into the market to buy outright close to 1 million effective shares. We were in a different. We had a 1-for-10 reverse split, so it was close to 10 million shares of net purchases, both through Mako and then through the predecessor company to get the bulk of that position. What I've noticed in this industry, this is it's probably I think similar to a lot of the micro cap side of things, but I think different to like a lot of other industries and especially more developed companies. People spend way too much time looking at I would say insider purchases and insider sales in this industry. I care about the business. I care about how it gets developed. These are stocks. Every investor that invests in Mako should have an expectation that they sell those shares. We set up our company through underwriting views that we don't anticipate our company being sold. We don't mind it. Like if somebody wants to come in and buy us at a premium, we're happy to entertain that. We do not structure our company with that in mind, which means by definition, management would effectively be wasting their time if it wasn't going to be at a certain point that they sell and monetize. Otherwise, we view equity compensation as part and parcel to incentives and compensation for what it is. So I do think because there's so much sensitivity to what insiders do, there's like a perverse incentive that goes on in the space where if there's a hesitancy of investing in a management team that's not going to be selling their stock, what the prudent thing for management teams, given those incentives to do, is to put yourself in a situation where you never sell your stock, which basically means you have to sell the company. So the perverse incentive is you're now incented to sell your company at a level that's likely lower than what it would wind up being if you just spent the time and rolled up your sleeves to go and develop the portfolio of assets like we're doing over at Mako. Is that we never want to be in a situation where the incentives that were being presented by the market are interfering with our actual business decisions. So like with me, like I said, I probably acquired over 1 million shares in aggregate between the predecessors and through Mako initially. I think I wound up like selling, I think probably somewhere in the neighborhood of about 300,000 shares of that in subsequent years. The amount of benefit that I viewed on the street cred, if you will, on the 1 million share purchase in those years was a tiny fraction of the negativity that I got on the selling of the 20 or 30% later on, to the point where it almost got to the point where the incentive structure that I was getting from shareholders was such where you're almost forcing me to develop this company to sell it. And it got to the point where I'm just not going to be responding to incentives like that. So I do purchase the stock every now and then. I do sell the stock every now and then. The position that myself and management and insiders have, we're all well incented to make sure that Mako does well. But one thing that I try to avoid is you can't manage your business via heuristics. You can't. There are no shortcuts to basically what are the assets, how are they being developed, what are the returns on capital that you're generating. Is your stock price cheap or expensive relative to how that goes? And you can't look at other stuff from the outside that interferes with that, because you wind up making cloudy investment decisions. And I think it forces people to make very unhealthy choices in terms of how their portfolios are developed. So, I mean, I can actually think of a few examples where I would notice management teams would actually go into the market and buy stock, and people say, "Wow, that's good." There's only one reason why management teams are buying stock is because they think the stock is going to go up. The answer is no. It's like when you're dealing with micro cap stocks, management teams sometimes are incented because they get the feedback from the investor group that they're buying stocks because they want to actually have some sort of raison d'etre to raise capital later on, or put themselves in a position where they have like a better, more attractive currency to do a potential bad deal to kind of grow their empires. And we just don't play those games. Really don't.
What's the average cost that you've paid for your shares? Do you know that?
Uh, I don't know exactly. I would guess that they'll probably be in the high ones.
Okay.
So probably someone like you could probably like recreate that, but I would say if I had to guess, like between 1.8 and 2
Right.
it would probably be where it shakes out.
Because really what I'm asking here, Akiba, is that you're saying, trust me, and you have to trust management. And I agree, but I add to that trust but verify. And so
Sure.
really what I'm looking for here is that skin in the game. And I'm really looking to try and understand how important the financial commitment is for you, especially given that, again, you do have diversified interests here and there. So how important of an investment or financial commitment is Mako to you?
I see Mako and Sailfish like as a percentage of my net worth. It's high. I would say the vast majority of it are tied up in those two groups. So it's definitely from a personal perspective, way in excess of 50% of my net worth.
Mm-hmm.
The to go back to trust but verify. It's we have this company. It's been like so in one form or another. It's been around, depending on how you count, from 2012. I like to count it from 2019, which is really the first time that we had this unencumbered company with the board working in the same place, with me in control of management and the board, with the financing to move things forward. So I view our inception date really to in the summer of 2019. But even with that, we're now operating this thing for 6.5 years. The two equity financings that we put in, one was a rights offering, right? So it was backstopped by Wexford. Wexford going to that rights offering had a 37% ownership in the combined company. But because they took 73% of the rights offering in July 2019, it got them into the low 50% threshold. I think that took them to about 52%. And then there was an equity raise that was done at 4x the price 1 year later in the middle of the pandemic to complete the construction capital for San Albino, of which Wexford took 60% of that deal as well. So throughout all of this, in terms of when, and they put in 15 of the $21 million of debt as well during the 2020 and 2021 timeframes as well. So all of this was actual capital coming in from the controlling shareholder and me at that point in time. So to your point about trust but verify, we didn't we didn't need anybody to trust us. We didn't need anybody to verify us because it was our own capital. And really, since that time, we now have enough of a track record in the space on how these assets are developed that after we announced the Mount Hamilton acquisition and kind of this rigmarole strategy on how we used Sailfish and Wexford to go and acquire it, our stock responded well enough, and then we did a very well marketed deal to go and raise. It was 40.25 million Canadian dollars going to outside investors and $15 million going to Canadian Wexford dollars. So in aggregate, that was about US $37 million net of fees that went in. And all of the people that I think there was 27 different institutions that came into the 40 million Canadian deal. All of them had very similar questions. And the way that I answered them is like, this is what we're doing. These are the four assets that we have right now. This is our track record for the last 6 years. And if you want to come along for the ride, great. If you don't, that's actually okay too, because we don't actually need to raise capital right now. We have cash flowing mines. To the extent that Wexford wants to put in more, Chuck can. We don't need your money. But if you want to come along for the ride because you like what we're doing and you like the track record that we had, you like the marketplace positioning in the portfolio, great, wonderful to have additional shareholders along the way.
Mm-hmm.
But the way that we've managed this company from the beginning is this is what we do. Like if you like it, great. Happy to be partners with you. If you don't, that's actually okay because we can actually develop our business without anybody's support, either through financial capabilities from Charlie Charter, or to the extent that it's been really the case since 2021, the ability to finance our growth objectives within the four corners of Mako, the ability to generate cash for these assets to grow the business kind of with our own internal financial resources.
Mm-hmm. This might actually be a good point for you to talk to me a little bit more about Wexford as well, because again, they own quite a lot, about half the company actually. And they also own a significant part of your other company, Sailfish, if I'm not mistaken. So again, it goes back to that partnership that you're describing there. So what is that relationship really? How did that come to be? And I guess more importantly, where is it going? Because they are going to have to make money on this investment eventually as well, or at least they're hoping to. So yeah, where did it come from? Where is it going?
So where it came, I guess a little bit about Wexford. So Wexford started in 1994, and then even before that, the CIO of Wexford has been a very well-known, successful investor going back since the late 1970s. So he's been around a long, long period of time. I joined Wexford at the end of 2011 after I left Red Kite, which eventually became Orion, at least on the part of the organization I was working for, to help take over their public portfolio of equities. And what often happens within the Wexford portfolios is, to the extent that there are industries that are particularly attractive to Wexford, they like getting information. They like seeing what works and doesn't work out there in the public space, to use that kind of as a way of developing and managing the whether it be private companies that they develop or control investments from a public side of things. All of those have happened. So when I started over at Wexford in 2011, we kind of going over was like what works in the mining industry, what doesn't, what's replicable, right? So it's not. I mean, to me, I think there's like two motifs, if you will, that make money in the mining space. The first one is really on the exploration side of things, right? So can you buy something, make a discovery, and then develop the discovery to a certain extent that somebody buys you out at a substantial premium? And we actually made quite a bit of money doing things like that in the public portfolio. But at least from a control perspective, it wasn't like us that were the best suited to be making those kinds of greenfields exploration bets. It was always a much better idea to invest in companies that are actually set up to do that. And then likewise, there was also a subset of companies where you tend to invest in low capital intensity projects and then develop along the development curve, and you can make money that way. Now, there's nothing wrong with either side. Both of those have both examples and counter examples of what works and what does not work within those motifs. But it was very clear that in terms of what was available to us from our network of people that wanted to work with us, our skill sets, what we kind of understand from an underwriting perspective, how do we replicate that type of business? It was clear that we were going to be on the second motif, if you will, the kind of like the low capital intensity, quick to return type projects, getting things into cash flow. There were, I think, a lot of mistakes that were made on the original transactions that created Marlin. So a lot of lessons that were learned there. But the fundamental thesis behind the types of assets that we were looking at over at Marlin are not different than what we're doing right now. Is that it really required, I think, a lot of getting spritz with a cold shower in terms of some of the things that we needed to do and do better on terms of developing the portfolio. But the types of assets that we like to look at, which are how do you get things into production pretty quickly and then know that your main reason why you're there for the assets are not for this small scale mine, but really to kind of like grow organically from the exploration side with the cash flows that you generate. So La Trinidad over in Mexico was not a success from an investment perspective, from an operating perspective. That being said, we are creative. We know how to get things done, and the creation of Sailfish and the acquisitions that went with it, the merger that created Mako, the 3 subsequent acquisitions. If you take a look at what we've done, the actual like business model that we were underwriting back in 2012 is almost identical to what it is now. The difference is a lot smarter, a lot more gray hairs that come with it. So this is now using that thesis, but with a lot smarter way of doing things. So and by the way, I think that the almost identical situation happened with Diamondback. The difference between Diamondback and Marlin/Mako is that the transition that Diamondback had to go through prior to even being called Diamondback was done in the private markets, where the company, in terms of how most investors looked at that, was really only after it transitioned to this really high quality management team and growth trajectory that happened since 2012. What we're going through right now is an almost identical situation to that. The only difference is that we basically structured everything kind of with an open kimono in the public space over the course of the last 14 years since we've been involved in the original investment that created Mako to where it is now.
Mm-hmm. Does having so much of the stock in one party and one that's not really trading a lot right now, is that prohibitive in any either operational, so business or market way?
So there's the clear net negative is arithmetic, right? So if you have a 48% shareholder, whatever our market cap is, don't expect it to have the liquidity of somebody of a similar size. You really have to look at it as like a float adjusted from a liquidity perspective. So we trade like a $250 million company and not a $500 million US company. So definitely, just from basic arithmetic, it inhibits your liquidity, and liquidity is important to a lot of investors. Now, the liquidity in terms of where we are today versus where we were 5 years ago, it's night and day, right? So, and it's going to increase over time. The unequivocal net positives is that this is an industry which has a lot of complexity associated with for what it is, right? So you're generally dealing with relatively small companies, but high levels of complexity. And what we've noticed is that because we actually have our fingers in different areas at the same time, that level of control simplifies things, right? So the creation of Mako, so the merger between Marlin and Golden Rain Resources was effectively a 4-way transaction. 3 of the sides happen to have been controlled by me and Wexford, right? So it was an extremely complicated transaction that created Mako at the end of 2018. But because they were involved in everything, it was actually a very simple negotiation. We were just waiting. I remember, like by the way, like the merger between Marlin and Golden Rain, I thought was going to happen in 2014, right? So I was trying to like come up with structures in place to try to get the 2 companies merged, and they brought in new management, and they wanted nothing to do with it. And so I was proposing like different alternatives and different creative ideas, like do this, and then it was at the beginning of 2018, and it was the CEO of Golden Rain called me up and said, "Akiva, I want to meet you in New York for lunch." So we have lunch, and he goes, "All right, I have this idea. I think we should do this, and this." And I kept my mouth shut, and I said, "Okay, I think we can work on it." What the CEO said to me, "We should do this, and this," was exactly what I was trying to get him to do for like the previous 4 years. But as soon as he was able to mentally say, you know what, this is what needs to be done, deal was like that. Like we were able to negotiate the finer points on the transaction within 24 hours after it was done. So even though it was a high level of complexity, so long as that the one side that was not in our control was able to say yes, then it was able to be pretty simple. And then likewise on this Mount Hamilton transaction, if you actually count the sides involved, there's five of them, right? And four of which are involved with myself and Wexford, right? So you have Sailfish is acquiring it from Waterton, and Sailfish is borrowing from Wexford. Sailfish is engaging with an advisor to sell this other asset not affiliated to Mako. Sailfish is selling the asset of Mount Hamilton to Mako in return for a stream and a royalty along the way. The one side that was not in our control was the owner, right? So as soon as we kind of understood what their clearing price was, all right, it's 40 million. All right, here's $40 million of cash. Let us handle the complexity, right? So that part's simple, is that a check was given, like Sailfish was able to borrow $40 million. $40 million went to Waterton, and then that part of the transaction got complete, and all the complexity we were able to handle with everything that we're involved with. So we use the complexity to our advantage, and we try to keep the things that are not in our control as simple as possible. And that's kind of our MO on how we look at things. And I would have every expectation, if you're investors in either side, on the Mako and Sailfish side, that we want to do more than that, than what we've done in that capacity. We think it's a good thing. This is kind of like a strategic advantage for us to be involved in multiple things at once. It's a good thing in terms of how we pull off deals of this sort. Now, the other thing is kind of like, I think a lot of people look at a large shareholder and say, all right, what's the overhang? Are they going to be selling? And what's their motivation over here? Wexford is held on to investments for a nanosecond. They participate in public markets. They have like very active macro funds and equity funds that they trade in and out of in very, very short periods of time. I've seen Wexford hold on to investments for decades, like literally decades. Since inception, Chuck has not sold a single share. In fact, he's bought along the way, usually substantially during financings, and tactically in the open market, to the extent that he's capable of doing that over time. So he's been probably the most supportive shareholder that you can possibly imagine. I used to spend a lot more time kind of trying to convince people that this is a good thing. And 5-6 years ago, it's like everybody was very concerned about that fact. I think now we have enough of a history over here that those conversations actually don't happen often anymore, because I think people kind of recognize just what a valuable asset it was to have a shareholder like that in place.
What is their end game? Did they ever talk to you about that? Like, how do they make money on the 50% that they've got here without crashing your stock?
Right.
Preferably?
So I mean, we're talking about like Mako and Sailfish to a certain extent, because I do think the exit strategies are different, right? So Sailfish acquired a bunch of royalties. The first one being the royalty on San Albino, so it's Mako's Nicaraguense mine. It bought a royalty from a private owner of a royalty on the Tocantinzinho mine, which got developed by the G Mining folks in an excellent fashion. That royalty was sold a couple years later. So we sold that royalty in 2021. I think we purchased it in end of 2017. And at the beginning of 2017. So it was a high return in terms of what we had. I think the royalty would have been worth a lot more today, given where gold prices are and the success of G Mining. We purchased another royalty in 2019 on the Spring Valley mine over at Sailfish for an aggregate US $31 million. And then we've publicly disclosed that Sailfish is going to be in the process of selling that royalty. I think most people can infer that a royalty will be sold for a large multiple on what we acquired that for. In fact, the largest gold royalty company in the space, Wheaton Precious, just put in a subordinated royalty to Spring Valley to us for $670 million a few weeks ago. So people can use that as kind of a reference point where we think pricing may wind up being, but who knows? We're running a process right now. So the exit strategy for Sailfish was actually fairly simple: is that you buy royalties and you sell them. You can sell royalties individually, you can sell the company. It's pretty straightforward in terms of exit strategies. The fact that Wexford owns 70% of it is almost an irrelevancy to the extent that we actually have minority shareholders over at Sailfish, and we do have substantial minority shareholders, inclusive myself, a couple of other large investors. We do pay a pretty high dividend as well to kind of like pay people to wait until the exit strategies take care of themselves. Mako's different, right? So Mako, it goes back to kind of like those two motifs that you have in the mining space. The first motif, which is you're investing in exploration, you make a discovery, and then you advance it to a point where it's saleable to a large company. I already said is that there's nothing wrong with an investment strategy like that, but it's just not what we do. That's not our DNA. We like to invest in it, but for people that are much better equipped than we are to making those types of investments. But one of the positive aspects of that motif is that there's a defined exit strategy there. You're investing into something. Hopefully, it pans out from the geological perspective, and then there's a network of larger gold companies that are coveting assets like that. The problem is that I think people have a little bit of a survivorship bias on that approach, is that they always look at the winners on the exits, and they don't look at like everybody that's been kind of like left in the desert, if you will, especially when we were dealing with a bear market in the space. For our approach, it's a little bit different, right? Because we're in that second motif where we have low capital intensity, high return, cash flow type investments. And if you think about the types of assets that we have, they were always in terms of what, if you actually wanted to optimize your portfolio for what quick to develop, quick turnaround, high return assets, if you want to optimize your portfolio on something like that, it tends to be smaller assets. Smaller assets, they tend to be easier to permit. Smaller assets tend to require less. There tends to be, believe it or not, diseconomies of scale when it comes to capital investments. So the larger projects tend to have more per unit capex than the smaller ones. So not always, but often. So it's almost ironic in this industry that there are diseconomies of scale. So they tend to be small. They tend to be things that can be developed quickly. The downside to that is that those are the types of assets that the mid-tiers and the majors don't necessarily want all the time. Sometimes they do, but not all the time. I think all the time they want really attractive exploration assets that every one of their geologist friends love. They always like that. What they tend, sometimes they do in certain markets, they like the portfolio of small scale assets, but not often. And if that's the case, you cannot underwrite your investment strategy predicated on you being sold to a larger company. And I think this is where people fall down, is that they said, oh, if only we get to 200,000 ounces a year or 150,000 ounces a year by stringing these assets together, of course somebody would come and take me over. The reality of that is that may have existed as a replicable investment strategy back in the 80s, the 90s, the aughts, and then to a certain extent 10, 15 years ago. There just really aren't very many examples of companies that have developed assets of the small scale nature and then sold themselves to a major for a clean exit. So we're operating on the basis that we're going to be doing good investments. We have 4 assets within our portfolio right now. Once we backfill with our team and our capabilities of handling these assets, once we're well into construction over at Mount Hamilton, we're going to be looking to do for more of these. And if we get to the point where we're actually at scale where a larger company would take a look at us, in kind of like the part of the market where sometimes that happens, but often it doesn't, great. We have no objections to do that. But we don't underwrite the business on that. We always underwrite the business on, is the investment that we're making generating a high return on capital? And this is where I think people fall down, with honest numbers, right? So there's a lot of companies that say, I really want to invest in this small scale asset with made up numbers. They like the spreadsheet math. I remember like interesting anecdote on that is that when my first job in this business was straight out of business school. I knew nothing, even though I'm an engineer by training. I was not in the resources industry before this. So in 2006, I would come in and it's like, all right, there's this smart, arrogant kid from business school. You're looking at it, and it was clear all development assets are cheaper than producing assets, right? I'm looking at all of this sell side research, and it's very clear that if you look at things on a price to NAV, the developers are cheaper than the producers. The reality couldn't be further from the truth. Almost invariably, development companies are more expensive than producing companies. It's just the numbers are made up, where it makes it look cheaper. And if you actually think, if you take off your mining hat a little bit and just think from a practical perspective, well, of course that's true. It's because if there was like a good project, it would have like a higher probability of it turning into a mine, right? It's like the lower quality assets are the one that's stuck in the development cycle over here, obviously with rare occasions with discoveries and new projects coming along. But I do think people like fall into this trap where they look at something on a spreadsheet. They look at these 43101 reports. They look at sell side research and said, oh, these look cheap on paper. But it's just you can't look at the world like that. So we underwrite our investments on the back of, can we develop it? Can we do it quickly? What are the returns that we're generating using real numbers? Because we just don't like partake in mining math. We like partaking in real math in terms of generating the returns that we need to generate to justify investments that we make.
Mm-hmm. Yeah. What about when you maybe a bit further to a point you made earlier when I asked you how do they make money on the shares? What is the goal for Mako here? You talked about that as well. You said like, if people care about the shares and whether you're buying or selling, they're kind of forcing you to build a company for sale. Do you want to keep growing it into mid-tier and then kind of run it indefinitely, then potentially bigger? Or are you kind of packaging assets for a sale in the near future? How do you see the future of the company?
No, I do think that having a platform is helpful, right? So having a public vehicle with clean balance sheet and an operating team that's capable of managing multiple assets at the same time with potential sources of capital external to what we have within the four corners of Mako are useful when it comes to looking for other assets, right? So having something within Mako or having like the Mako platform there means that we can do something with other assets more effectively than just looking at individual assets by themselves. So it's helpful to have a platform, which means there's a lower hurdle rate for us to look at things that can potentially be plugged into to what we have that makes sense. That being said, there's no set number, right? We'll do things that make sense. The more the marketplace gives credit to it, the easier it is for us to do things. If you actually take a look at and even going back, like I often got I was like I like talking about Mako. I don't like talking about Marlin because Marlin wasn't a successful investment at the end of the day. But even going back to Marlin wasn't a good investment because of the mistakes that were made. But how we pivoted from there to where we are right now, I think was fantastic. It was like a masterclass on horse trading, on getting from where Marlin was to vending it into Mako, to taking control to the asset and portfolios that we have right now. So my objective is given the constraints that we were operating under, some that we put on ourselves, and then certainly some where the markets were putting us on, because as you pointed out, is like people did not want to give us the benefit of the doubt in the build out over here. Given the constraints that we were operating in, we actually pulled off pretty darn accretive transactions on the back of Gold Source, Moss, and Mount Hamilton. To the extent that those constraints get removed, that just makes my life easier, right? So the types of assets that we were able to pull off was what was available to us given the constraints that we were operating in, which meant that we were actually looking at a very, very narrow window of things that we could do. And then to the extent that the handcuffs come off, if you will, it actually just means that we're able to use our creativity to do more stuff, to make it more likely for us to do better quality deals, because we'll have access to different types of capital, different currency within our share price. This everybody like is talking about vicious cycles in bear markets, but there is the other side in bull markets on the virtuous side of things. So we'll always look for more in that regard, but it's not to get to a specific size. It's to get to a point where we do more smart deals, right? And like it could be on the buy side, it could be on the sell side for that matter as well. Just so we just look at the world as I guess, what do we have available to us? What are our constraints? And then is there something smart to do given the constraints that we operate in? If the answer is yes, we'll do more. If the answer is no, we have no issues sitting on our hands.
Would a strategic partner possibly be part of that?
Yeah, I think there's a little bit of a difference between normal assets in the gold space versus normal assets in the energy space, for instance, where just because of the nature of what they are, I think the interesting thing about energy investments is that they tend to be like front end capital loaded and then very, very high returns on cash from there. Whereas mining, it's kind of like this weird situation where actually a lot of capital needs to be spent before you actually make like the real capital decision. And then even after that, there's potentially further capital needs that come later on, which makes it not ideal for partnerships. But like there are certain circumstances where sometimes those do make sense. So it's not like there may be like a bias against that for the types of assets that we have, but it's just a bias because of the type of industry that we operate in. And if something actually makes sense on paper with real numbers, then great. I have no issues with that. But I do think JVs in the mining space for relatively small scale assets are not. They tend not to be great, like in the mining space. I haven't really seen like a replicable fashion of strategic investors at the project level coming in that would be for the benefit of the minority company. Sometimes that happens, but it's not nearly as frequent.
Why I asked that, Akiba, is because I was thinking whether there really even is room for a strategic partner with, again, Wexford at 50%.
Oh, that part's different, right? So the room really is about the size and scope of the assets that we have, right? If a partner comes in with like a really attractive capital program, but like those are the types of deals that Wexford loves, and in fact, I would say like Wexford is more inclined to do that than I am. So it goes back to having a large shareholder there. There are certain things where it potentially can complicate things. It could potentially obviously reduce your liquidity. When it comes to actual decision processes on deals, it only simplifies things. It really does. So that's not the reason. The reason why there's a bias against potential JVs is just the size and scope of the assets that we have versus the people that would be coming in with balance sheets that like we have a pretty pristine balance sheet right now. So people that have even better balance sheets and more access to capital that we have, the types of assets that we have, it's hard to see somebody coming in at the project level for a deal that would really make sense. At the corporate level, great. Like if somebody wants to come in, fantastic. And at the project level, somebody comes in with something fantastic, even though we have biases, we're also capable of recognizing that and can evaluate it on a case-by-case basis.
When is the time going to come where you no longer even have to think about needing a partner in the first place? Like how long before you no longer need outside capital in the first place?
Yeah, so it's interesting on the Mount Hamilton transaction is that we really did not need to raise capital. And this was I actually did I actually came to Wexford's office and I was doing the proverbial bang on the table is that I actually do think we need to do this because the alternative was we could wind up getting the cash flows from San Albino, the cash on the balance sheet. So it's before we did the capital raise, we had 28 million bucks on the balance sheet, and Mount Hamilton will likely require about US $85 million to build. So we had 28. We had an operating mine in San Albino that was generating cash after a particularly weak Q3. There was going to be a strong Q4 and for the foreseeable future after that as well, generating cash. Moss was in ramp up mode. So by Q1, it would be in commercial production. So those two assets over time would generate $85 million to build over at Mount Hamilton. In order to do that effectively in that bootstrap basis, I don't think there was a circumstance where that wouldn't cause a delay to Eagle Mountain. So we're expecting to get full permits on Eagle Mountain by say the very end of next year. So once Mount Hamilton is in trailing off on its construction, we could either delay the construction of Eagle Mountain from, let's say, the first half of 27 to maybe the end of 28, so delay it a year, and then not be in production until 2029. Or what I told investors is we could raise a little bit of money. It didn't need to be more than US $40 million max. So we raised US $37 million, like straight down the middle. And in doing that, that gave us enough capital where we don't have to make that decision to delay Eagle Mountain at the back end, because the three assets at that point in time would provide enough cash resources to easily develop the $100 some odd million project that Eagle Mountain will be. Starting in the beginning of 27 from a construction standpoint. So even now, we had the types of assets and the ones that we were specifically coveting and looking for were assets that could effectively be bootstrapped, right? So within the internal capabilities of the company. And even in this particular circumstance, so I got some criticism. I used to have a tagline on my presentation is that Mako Mining, we gold growth in the Americas without having to issue equity capital. And then lo and behold, we issued $37 million of equity capital. Well, yeah, we issued $37 million of equity capital, but we didn't need it. Like we could have bootstrapped it. But I do think in the context of this market, it made sense to accelerate the timelines on Eagle Mountain from that perspective. But certainly the types of assets that we were looking at were where we were looking at it, given the constraints that we were under, is that given the fact that we didn't feel like it was an attractive use of our equity to be issuing stock to buy things that are out there, what are the types of assets that we can do given the constraints that we operate in? I used to get this criticism. I was very vocal about our acquisition strategy going back since 2019 from the beginning, and then the stock performed well in 2020 during the pandemic. And then we actually did have some operating issues over at San Albino, and the stock did draw down pretty significantly from 2022 to 2023. And I was still talking about M&A. And then people were saying, well, why are you talking about M&A? Don't you want to fix your stock first? It's like, the answer is like, we're not going to do anything that is dilutive, right? So it's like, our stock might be down and might limit our abilities to pull off transactions that are out there. But given the constraints that we're in, we actually were engaged with other companies that had larger drawdowns than what we did. So I started talking to Gold Source in Q1 22 about M&A, and we didn't pull the trigger on it until 2 years later when we announced it in February of 24. The Even though our stock had a drawdown associated with it, the original terms that I gave Gold Source was actually better than for them than what it wound up being at the end, right? So even though our stock had a drawdown, we actually did a better deal for our shareholders' perspective. The Now, because we're in a bull market and some of the constraints are being removed, is that we do have more opportunities at this point. So it's like we were looking at assets between Eagle Mountain, Moss, Mount Hamilton, and things that we can advance with our internal resources. To the extent that we actually have a currency to do something, which it's debatable about whether we have one right now, then great. It just means we can look at more things. The only thing that matters to us is that using honest math is a deal accretive. And if the answer is yes, then and we're capable of handling it within the human resource constraint that we have, and then the longer term capital constraints that we have, then great, we'll pursue it. And if not, we won't.
Yeah. Akiba, I know you don't have too much time left here, and I do want to talk about some of the money that you've got right now. What did you say? Close to 70 million US?
Yeah, we have a gold shipment out by the end of the week, so including those, we'd be about US 70. Then we
What are you going to do with that money? How far does it get you? What does it buy you?
So all of our assets have what I would consider to be big boy exploration programs. So we do like to have our assets in cash flow first and then invest in it on exploration. So San Albino, so I think you highlighted earlier in this, like a relatively low exploration number. That's just our expensed exploration. If you actually look at our capitalized exploration, our land purchases that go with it, or the G&A associated with our exploration team, we spend probably about $9 million a year in San Albino. Over at Moss, we have between our exploration program and our capital investments, like increasing leach capacity or leach pad space over the course of the next year, there's probably going to be capital investments in the $15 to $20 million range over at Moss. Both of those numbers are a tiny fraction of what each individual mine is capable of producing from a free cash flow perspective. So both of them are going to be very easily self-contained units within what they need organically. Then everything else is going to get earmarked to initially Mount Hamilton. So we'll end the year at let's call it mid 70 million as a number on the balance sheet. US, between that and the cash flows coming from net of exploration expense from San Albino and Moss, will have more than enough to invest in the $85 million capital development for Mount Hamilton. And then we should have enough of a cash buffer that as soon as we're capable of moving our EPCM from Mount Hamilton to Eagle Mountain in Guyana, because hopefully we'll get full permits on that by the end of next year. So let's call it when Mount Hamilton's towards the tail end of its construction in early 27, we'll pull that team off, move to Guyana, and then use the cash buffer and the cash flows coming from those three assets to go and build out Eagle Mountain, which should be roughly a US $100 million capex build on that. With the resources that we have, cash on the balance sheet and the cash flows coming from those three assets. So we have more than enough. I mean, the capital raise that we did, like I said, we didn't need to do that. But by pulling the trigger on the capital raise, it gives us all the flexibility where we don't think we need to delay any of the projects to develop enough internal cash resources to go ahead with any of our project developments at this point.
Mm-hmm. I guess many things to follow up on there potentially, but what do you think will be the biggest challenge in the process of spending that money or deploying it wisely, I suppose?
From an exploration perspective, I haven't seen anything at San Albino that I wouldn't invest in, right? So our constraints really weren't our expected returns on dollars spent on exploration. It was really on what is our team capable of handling? Can we actually get rigs? Because at the end of the day, it's like if you're managing 6 or 7 rigs, it's not just 6 or 7 rigs and having the drill contract. You need to have like each rig needs to have at least 2 geologists on it with the shift work that needs to be done. So by managing that, you're actually running a very large exploration services group, like logging and just basic data management at that point in time, and obviously the data evaluation that comes with it. So really, for the last 5 years, we've never been constrained by opportunity sets in Nicaragua. It's always been constrained with human resources. Even when we were running on fumes, all exploration capital was basically getting invested just because the expected returns were so high. Moss is a little bit of a different situation where we bought this asset from a company that was insolvent, so they cut down to the bone in terms of their operations. So there's a lot of things that needed to be followed up on for the last 8 years that just haven't been from the exploration side. So but we're fairly disciplined in how we do this, is that we need to get Moss like up and running in steady state by the end of Q1. We've just engaged our outside geologist work to do some pretty high level geochem work on near pit expansion plans over here. Likewise, we're working on permit amendments with the federal government right now to give us some more flexibility on what we actually can do at this point. And so, but Moss will have like a very substantial exploration budget for what it is. We're going to need to upgrade our staffing on that as well. Now in Hamilton is in a little bit of a different situation, is that our very near term stuff that we obviously spent the last 6 months kind of redoing that resource estimate. So just getting something that we can build a mine plan around. So that was number one. But now we have to go and do the infrastructure type drilling. So condemnation work, confirmation holes from infill, metallurgical holes to make sure that make sure that we have all of the information that we need in building this plant. All of that's what's going on. There's some very, very low-hanging fruit on the exploration side of things, but we do need to be able to finance that through cash flows coming from the individual assets. So I think a lot of the expansion type exploration work at Mount Hamilton is going to wait, with one caveat, is that we are sitting on top of a very large scale critical metals potential deposit, previously a deposit, that if the government actually wants to help us advance that quicker, then we're all ears for opportunities that may come along that route as well. But without government support, I think that actually is going to be pushed off a little bit. And then with respect to Guyana, the way we've been managing that since the beginning of last year is it was quite a bit of drilling, but that was focused on the infrastructure work. So geotechnical, hydrogeological stuff, a little bit of infill work, metallurgical work that went with it in order to submit our permit application so we can actually start constructing this thing at the beginning of 27.
Mm-hmm. And also, if maybe we can take it step by step kind of and go through some of these things. I guess Nicaragua is the most important part here for you. What about political stability down there and kind of jurisdictional risk, given that a lot of your current strategy does depend on Nicaragua? How stable is the political, the fiscal, and the permitting environment down there?
Sure. So the biggest risk any mining investor takes is jurisdiction. Can't move your mind. Like, so that being said, going back to how investments are underwritten and how your portfolio is optimized because of that, is that if you are in motif number 2, which is low capital intensity, quick returns on capital, you need to be in jurisdictions where you can do things like that. So I would, when we started out, I mean, we were involved with the predecessor company in Nicaragua going back since 2014. When people would criticize us for being in Nicaragua, and he says, like, we can't invest in you because you're in Nicaragua. We only invest in good mining jurisdictions like the United States and Canada. And like, I would basically say, all right, that's a very interesting point you have. Hang up the phone and then just laugh my you know what off, because they really just did not understand how difficult it was to make mining investments in in the United States. So we were talking about the Spring Valley asset before that Sailfish has the royalty on. That was the first EIS of a primary gold mine to be delivered in the United States in 11 years, right?
Hmm.
So the United States was not a good mining jurisdiction until the new administration came in, and kind of I would actually include that in the previous Trump administration as well. But specifically things have changed where you can actually get things advanced further. So Nicaragua happens to be one of those jurisdictions. Guyana happens to be one of those jurisdictions as well. Mexico is not a jurisdiction like that now. It used to be like 10 years ago where you could get things done quickly. That's not the case anymore. So you do need to have a little bit of a grounding in why are you making these investments? Is that you're not making these investments because it's where you like to go on vacation, even though Nicaragua is a wonderful place to go on vacation, right? Beautiful beaches that come with it. I think most people's criticism about it is the government, right? And from the government's perspective, there's a lot to criticize, and the government does not have a good relationship with a lot of the countries within this hemisphere, right? So there's definitely elevated risk that comes from that. Nicaragua was put under 3 stages of sanctions by the U.S. and Canadian governments, going back from the original Trump administration, and then twice under the Biden administration. One of them, that the initial reading on those sanctions were actually pretty severe. It turned out we actually didn't really have any operational issues associated with it. But the way that I like to describe it to folks is that the probability of moving from sanction 3 to sanction 4 is higher than moving from sanction 0 to 1, right? So the seal, if you will, has been broken. There's definitely an elevated geopolitical risk that comes from that. It wasn't the primary reason why we went on for a geopolitical diversification strategy. I think that it really was driven by what opportunities are out there. But at the end of the day, it's like there is an optimal number of mines you want to run as a mining company. It's not one. It's not 17. But it's probably somewhere in between. For a whole host of reasons, and not just for geopolitical issues. It's like for weather issues. I mean, we've gotten hit by some pretty substantial storms in our construction development. It'd be nice to be in different areas with a level of diversification that comes from that, just from a risk management perspective. So I get the people who are making calls on geopolitics in general. I think those are fair. What I usually push back on is that, well, what exactly are you investing in as an alternative? Don't come to me to criticize the geopolitical risk that Mako has when you're investing in the GDX, like for instance, right? The GDX has a lot more geopolitical and bad government governance than Nicaragua, right? In terms of what some of those very large cap companies go through in terms of some of the jurisdictions that they operate in. And then likewise, have some sort of grounding as to what you're actually investing in. And given the fact that we're in this motif too, like these relatively high return, quick to production type assets, you really do need to be in jurisdictions that allow for you to do that. And the jurisdictions that we operate in are that, right? So I view Nicaragua as a country where you can do things quickly and responsibly. I view Guyana as a country where you can do things quickly and responsibly. I view the United States now as a jurisdiction where you can do things quickly and responsibly. That was just not the case 5 years ago, not the case 2 years ago, not the case 1 year ago, for that matter.
Yeah. What about safety? How's safety and security on the ground? Like if I visited, could I go and, go for a walk after dark?
Yeah, so actually, that's the one thing about Nicaragua that's interesting is that from a safety and security from a personal safety and security perspective, yeah, it's great. You can walk around El Hicoro. We do often, sometimes ill-advisedly at 2 o'clock in the morning, coming from a local bar, and because we effectively employ about 15% of the entire community of El Hicoro, and probably if you factor in touch points, it's probably closer to 40 or 50% indirectly as well. So we are a company town. We don't have like a man gap. We're actually in the town, and the mine is about 6 kilometers away from the town. Um, Guyana has always had sporadic like random criminal activities here and there. It's been pretty okay for the last 15 years, but 20 years ago there was kind of a problem. Like one of our directors used to be the CEO of a company that was developing an asset in Guyana. He actually had some personal security issues back in the early aughts. I think to a large extent that is definitely calmed down. And then the U.S. is the U.S. Bullhead City is a lovely town in Arizona. Ely, Nevada is lovely town in Nevada.
San Albino is also located, if we, keep talking about Nicaragua here, it's located in the hilly area of the country, making the potential, I suppose, discharge and leach pad management, I suppose, more challenging or not. You can talk to me about that. But really what I'm wondering about here is within the context of government. So does the government expect you to be doing something different or more from someone who operates in a more flat terrain?
So the decision was made, I guess specific to tailings management. The decision was made to make this a zero discharge facility, number one. And then number two, we're the only company operating within Nicaragua that has a dry stack tailings, filtered and dry stack tailings storage facility. You don't need to do that in Nicaragua, but it certainly buttressed our credentials when we suggested that to the government, and then they approved it, and now they actually look at us to as a nice template for what to do, and then probably to needle some of the other companies there to see if that they can actually transition to filtered and dry stack tailings as well. The hills that we have actually are helpful. Is that we actually put the TSF within a little valley between some hills. This is not like our the biggest hills that we have like in San Albino wind up being like 120 meters high, and then at elevation, the top of our mine is like 640 meters above sea level, and then the bottom of our mines they go as low as maybe 400 flat above sea level. So this is not hold your breath, oxygen, super peak South America type mining. This is actually pretty easy to deal with. There are areas of sensitivity. Is that the most productive areas that we have within San Albino are tucked between two relatively large rivers, San Albino and the Susquehanna River. So we're like all of the mines that we've developed have been between the two. So we don't mine within 200 meters of those rivers. Like I said, we have zero discharge. We did get hit by two major hurricanes back in 2020. There was no discharge at that point in time. Rainy seasons have been manageable. So fortunately, we've not had any discharge necessity since that time, but we do have protocols in place in case that may happen. Guyana, yep.
Is there enough water? I mean, now that you're talking about rain, again, water is a big thing everywhere, really, but definitely Nicaragua. So what's the water situation for you?
It rains on average about 1.5 meters a year, and then, which I thought was a lot until I think it was like after we certainly after we had a handshake with Gold Source, but it was late in the process where somebody actually said, "Hey, Kiva, do you know what it actually rains in Guyana every year?" So Guyana is like I think about pushing close to 4 meters of rain per year. The difference between Nicaragua and Guyana, like Guyana has no hurricanes, right? So it's like just constant like dribbling of rain a couple hours a day. Their dry season is not dry. Their dry season it still rains. It just rains less. Nicaragua has like two very distinct seasons, and especially the front end of the rainy season, the back end of the rainy season, which we're just coming through right now. It's like if you want to go to Nicaragua or Costa Rica on vacation, this is the perfect time to do it because like it's not going to rain anymore until May. Um, in terms of access to water, we have more than we need. In the United States, water is sensitive for the other side. So in Bullhead City, one of the things that we did during that 3 month period of time where Wexford owned this prior to Mako owning this is that we did improve the wells system there. So we do have access to groundwater, and we think that's going to be sustainable for a long period of time. And then we closed the first part of the transaction on Mount Hamilton a week and a half ago, right? So we actually took formal delivery of the keys to the mine last Wednesday, and so we were down at site over Thursday. And then one of the things that we super top priority for us was to make sure that we rehabbed and protected those wells, right? So to make sure that nobody's going to be dumping anything in that. That's now our responsibility from an environmental perspective. So that's taken care of. Now we have security on site, and we're good. And we should have more than enough groundwater to run our operations. Also as a zero discharge in both Moss and Mount Hamilton as well.
How much life of mine do you have left in Nicaragua? I know you're going for exploration, you're hoping to find more, but what if I mean, just right now, the way things are right now, how much LOM do you have left?
Yeah, so we updated the resource. This goes back to the comment that I made about we care a lot about math, but with real numbers, right? So back when the predecessor company was running this Golden Rain, they put out a 34-year mine life on the back of San Albino only, albeit running at a pilot plant rate of 250 tons a day. So about a 900,000 ounce all category resource, which was complete BS in terms of some of the assumptions that they made from a modeling perspective. Now, I've seen worse resource estimates in this industry. It's kind of like a common theme amongst the market. And it's not just within the juniors; it's within the seniors as well. But this is a complicated geology. You really need to get the modeling down right. So one of the things I'm actually most proud about with San Albino, I've got a lot of criticism for, is that one of the first things that we did was redo the entire geological model and restated the resource back at the end of 2020. Took that 900,000 resource down to 270,000 ounces, which basically meant it was about a 4.5 year mine life at 2020. Although that resource was done with painstaking details that I was 100% confident that we were going to positively reconcile, inclusive of our inferred ounces. We redid, and that resource then included our second mine, Las Conchitas, at the end of 23. So even after 130,000 ounces of depletion, we added 110,000 ounces net. So there's a 370,000 ounce resource, 380,000 ounce resource on the books that's been depleted since the end of 2023. So if you wanted to redo that net of depletion, inclusive of the open pit and underground, probably have about 3.5 years left. We expect the underground mining permits to come imminently, as early as today. So I think there's a high likelihood that we're going to be getting them this calendar year. I'll put out an update by our Q1 operating update, so by the third week of January, if and when that comes out. And then the thing about our underground is that really since inception, there's been very, very few drill holes that were put in deeper than 100 meters from surface, right? So our entire resource database is limited by data. So if we can prove that the underground mining is economic and robust, and we think it is, that just opens up the door for pretty substantial increases in mine life, because then we can focus on underground drilling and then expand it. I think San Albino is very analogous to narrow vein, high grade mines where you basically run at a 3 or 4 year mine life that keeps getting replenished. So in 2020, we had a 4.5 year mine life. 4 years later, we have a 4 year mine life, and I think it's going to be analogous to that over time. It's just the nature of the beast with the geology that we have in Nicaragua. Moss is different. We're going to be redoing our resource the first half of January, and then we'll have an update reserve and life of mine plan that will be out 6 weeks after that, so likely early March. Now we'll show a pretty substantial mine life that we have, but really on just the postage stamp on our property. And then one of the things that we're doing on site starting this week is to kind of like prep our exploration team to do some near mine exploration work. And then Mount Hamilton and Eagle Mountain are a little bit different, is that all of the drilling that are essentially done between those two assets are going to be focused on the mine build out, making sure that the mine plan and resource and metallurgy and for Mount Hamilton and then for Guyana over the last year, our geotech hydrogeological work was taken care of. And then once they're in production, then we can start taking a look at expanding those mine lives. Whereas the delineated mine life for Mount Hamilton right now is about 7 years, although we do think that there's pretty low-hanging fruit to get that gold oxide to a 10 to 12 year mine life. And then for Eagle Mountain, we have a 14.5 year mine life, and we do think that there's quite a bit of upside to that as well.
Mm-hmm. Yeah. I know we won't have the time to go in depth on the geology here, but maybe you can talk to me about that. What keeps you up at night from a technical perspective, given the fact that you're mining, again, high grade but narrow veins here. So really what I'm looking for here is, or would like you to talk about is geometry. I mean, there's pinching and swelling and all that, but how easy is that to manage? And yeah, what else keeps you up at night from the technical side?
Yeah, so actually, when we were doing the equity deal, there was like an investor, I think in Asia, that it was a question that it was really intended as a criticism, and they actually had a good point with it. Is that it's like it seems like all of your geologies are different, right? Mm-hmm. Which is true. So you have San Albino, which is this like narrow vein orogenic, so this mesothermal system over here, where super high grade, super narrow, like the average width of the vein is only running about 80 centimeters. Sometimes it pinches and swells to 5 or 6 meters, but on average you're talking about 80 centimeters. So for the geometry on that, it's complicated to get continuity to develop a resource around that. And likewise, we have added complexity with respect to metallurgy, because the host rock is in a carbonaceous schist where not all of it is preg-robbing, but some of it is, and you can't tell the difference between one or the other just visually. So everything needs to be sampled, and the protocols that we have for keeping everything in control are, I don't think there's another mining company that is mining the way that we are in San Albino. With respect to Eagle Mountain, that is an intrusive system. So you're dealing with an ore body that's probably about 30 to 40 meters wide. Lower grade. So you're dealing with in saprolites about a 0.9 gram deposit in the hard rock. You're talking about like 1.2, 1.3. The type of geology that this is pristine metallurgy. So super simple, super clean, completely different what we have over at San Albino, and in all aspects except for one, which is at least in the open pit parameters, are actually being mined in fairly similar fashions. Very shallow dipping, horizontal in the case of Eagle Mountain, and then 20 to 30 degree sub-horizontal at San Albino. And then if you think about kind of like my second motif point is that horizontal ore bodies you tend to get into quicker, right? For obvious reasons, like it's near surface. So that's kind of why our geologies are different, because that's not what we're optimizing for. We're optimizing to quick returns. We're not optimizing because we have like a particular geological thesis here or there. And then for Moss, I would say it's straight out of the textbook, low sulfidization epithermal deposit in this very large regional caldera. We do think that there's definitely areas where you have this disseminated low grade ore body, and then occasionally you'll have these structures in place that will have high grade quartz hosted type deposits as well. And then you have Mount Hamilton, which is kind of like another oddball, which is you have this skarn geology, where at least the upper part of the skarn was overprinted by this gold silver epithermal deposit. And then, but if you think about all four of them, they have a lot of similarities in terms of how they're being mined, the quickness of time to turn these things around. But literally all four of them are completely distinct from a geological genesis perspective.
Metallurgy, you're partially dealing with carbonaceous or graphitic rocks. Is there a preg robbing behavior in the cyanidation circuits, or what's that looking like for you?
Yeah, this is something where I mentioned earlier where we had our drawdown in the stock from 20 late 22 early 22 to late 22. We've had two significant drawdowns on Mako's stock during the bear market. One I thought was fair by the market, which was then where we knew that when we were going to be in fresh material, there was going to be some issues with dealing with the preg rob. And then there was another one which I thought was just silly, which was in 2023, where we had a scheduled week Q3 and people didn't like what the stock was doing, and then
Hmm.
Q4 was strong, and I just bought as much stock as I possibly could at that point in time. But the 2022 drawdown was interesting in that even though we knew that it was coming, I think we were a little bit overconfident on dealing with it. So the nature of the beast is that uh, when you're dealing with preg rob material, you basically do three things. One is before it gets into the mill, because the end of the day, the high grade part of the ore body is hosted by these quartz veins, and then most of the gold is within it. And then the host rock, the hanging wall and footwall, and the host rock is within this carbonaceous schist, where potentially that can be bad. So first order of business, just mine this selectively. Try to get as much of the good stuff and as little as crap as possible into the system. So we have very, very detailed mining protocols in place. We control dilution on either side of the vein to less than 25 centimeters. There's no other mining company that's doing this on an open pit basis as selectively as we are. Secondly, try to recover as much as you can gravity. So before anything goes into your CIL tanks, just pull it out from a gravity perspective. So we now kind of run our Nelsons. We have probably overcapacity on our gravity circuit just to pull as much as we possibly can. So we cover 38 to 40% of our gold via gravity recoveries. Our system is pretty fine grained as well. So we're never going to get like super high gravity recoveries, but mid to high 30s is doable. And then the most involved bit is make sure there is no active cyanide in the system before it hits those CIL tanks. So in 22, we had a couple of issues, right? So the first issue is we designed the system to have a cyanide detox protocol like called an Inco SO2. Normal process is nothing is like super advanced, but none of our guys actually the local Nicaraguense group worked with that before. So we were not getting our cyanide because we're a zero discharge facility on the front end of our mill down to zero. Like 0.1 ppm is not good enough. You get this down to zero, like when all is said and done. And when you're actually putting in like 8, 9, 10 ppm cyanide, you're gonna have some issues. So we actually had to pivot where like actually it goes back to kind of like working in Nicaragua is that so think about this, we got permitted for this detox system over here for this Inco SO2 that wasn't working. So while we were figuring out our problems, we asked the government, could you actually change our protocols in place and then just change our detox to a much more simple process of putting sodium hypochlorite, effectively like Clorox, into the system in place. So San Albino for like 6 months smelled like a swimming pool. But during that time, we actually had a changeover from our permit, where the government in a matter of a few weeks just like signed off on it and said it was fine. You never be able to do something like that in the United States. It would require like a complete change in the permitting protocol. And then finally, we figured out our detox protocols where we actually have a much more advanced based system than an Inco SO2 process to detox our cyanide in place. But it is a metabisulfate based detox approach where right now we have zero going through the system. So when we're in oxide, which doesn't have any preg-robbing components, we'll recover 93-94% of a gold. When we're in like high preg-robbing parts of the plant, ideally we'll get like 80 82% type recoveries. You blend those two components together, you'll get like 84, 85 ideally. In 22, there were certain quarters that we were in the 60s. Now everything is ideal. Like we're straight down the fairway at 83, 84% for our combined approach. The other assets don't have any like metallurgical issues, so it like keeps our metallurgists just focused on more just plant optimization instead of the science experiment that San Albino was.
Yeah. Akiba, we've been at this for almost 2 hours now, and I still have plenty of questions, so it might be worth it to schedule another conversation. I don't want to waste your entire day. As I promised at the beginning, I was not going to waste too much of your time. I don't think I've kept that promise too well, but it has been a good conversation. What's your most fair criticism of Mako right now? What's the thing that you hear about the most?
On the fair criticisms or just the criticism in general?
Yeah.
I would say on the fair side of things, the people need to know what they're investing in, right? So, and I do think because of the types of investors that are in the industry, and then the types of successes that have happened, I think most investors have the expectation that this is going to be a first motif type asset, like i.e. you basically make discoveries and sell to a larger company, where that is just not, it's not the nature of Mako right now. So there's this timing issue where I do think it required a lot of almost training for our investor base, where I think a lot of our investors were in this because they thought it would be sold at a high price, when in reality we were building a business. So the types of assets that we have, for people that are looking at having clean exits within their portfolio, it's just not the type of company that's set up to do that. The assets that we have are on the smaller side of things. I think there are complexities with the assets for different reasons. San Albino, we spoke about very complex geology, very complex metallurgy. We're going to be going underground as well next year, so that's going to be added complexity associated with it. The other side, it happens to be off the charts grade. I mean, the average grade of our veins are running 17 grams, so that's a huge positive. Lots of negatives that come with it. Yeah. And the other types of assets that we have, each one has its own idiosyncrasies, like Moss being low grade. Eagle Mountain having this kind of like weird dynamic with a critical metals deposit, as well as this pretty bog standard heap leach opportunity as well. And then Eagle Mountain also has this two-stage process where it has a very easy to process saprolite, and then you're going to have a higher cost, albeit higher grade operation for the hard rock as well. So every single one of our assets have idiosyncrasies associated with it, and there needs to be the expectations because of those idiosyncrasies that things might take longer than anticipated, and certainly we've had our hiccups in the past. The plus side to that is that there are very few companies that have set up themselves with the types of economics that our assets are capable of generating relative to the amount of capital that's been on this business. We're not the only one. There are actually other examples of this, which I actually I won't speak kindly to our competitors, but there are examples of this, and I do think it's important for investors to actually, like, especially for operating companies, look at the financials, right? And I think everybody wants to have like shortcuts on these investments because they're investing in these complicated businesses. Sometimes it's easy to look at the numbers and what they can do. Don't just look at the balance sheet and you see like, well, this company has. Actually look at what kinds of returns are these people generating. What kinds of income are these people generating? What kind of cash flows relative to the amount of capital that's been in the business are these people generating? And can you put something together that doesn't require a lot of external capital requirements? So the biggest thing that we could say is that we put together this portfolio without the need for external capital since 2021. And then this $37 million raise that we did was not needed. What that did was it really helped buttress the balance sheet, so it takes off any any real delays for getting our fourth asset up and running. And it gives us a great runway to go through. But if you look at how this company's developed, it got developed without the need for the market's support. So goes back to like the irony is that like we don't have any analysts covering us, right? Like for instance, it's like, well, people complain. It's like, well, Mako, don't you have any like analyst reports to look at? Well, we don't have any. The reason why we don't have any is because we didn't need capital. So you need to pay people to actually give you research reports over that. So I just tell people, follow what I say, what I do, follow our financials, what we do, take a look at the assets, take a look at the stuff that we acquire, and most importantly, how is acquired, how the trajectory of our balance sheet has gone over time. And what you see is that this company is very, very different than the vast majority of our competitors out there in this space.
Again, Akiba, I think there's a lot more that we could get into here, and I'm sure I'm forgetting a lot of important stuff, but I'm also sure that people watching and listening will let me know what I'm forgetting so that we can target it at a future conversation. But I really do appreciate you being so generous with your time. Thank you so much for doing this.
All right, take care, Anthony.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. So unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks, or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."